Okay, so the date is February 13th, 2026. Right now, the market is absolutely flying, just soaring on this incredible wave of AI optimism. But a new analysis is making waves, suggesting that maybe, just maybe, beneath all this excitement, the foundations are actually pretty fragile. So is this a new golden age, or are we standing on the brink of a major collapse? Let's dive in and see what it says.
Just look at this number. Right now, the S&P 500 is clocking in at a jaw-dropping 6,836.17. I mean, on the surface, everything is flashing green. We're talking record highs, all of it driven by what feels like the limitless potential of the AI sector. It really feels like a time of incredible market strength. But is that the whole picture? And that, right there, is the big question, isn't it? Are we living in a brand new era of endless prosperity? Or are we just at the very peak of a massive tech-fueled bubble? Well, this new analysis we're digging into argues that underneath all the optimism, we might be ignoring some really critical risks. The report uses this pretty powerful metaphor to describe what's going on. It calls the market an algorithm-dominated sandcastle. From a distance, it looks amazing, solid, perfectly built. But it's sitting on a foundation that could get washed away in a single wave. And the reason for this fragility? It comes down to one single, kind of staggering statistic.
That number is 89%. Just let that sink in for a second. 89%. What in the world can make up such an overwhelming majority in our global financial system today?
Well, here it is. That's the percentage of all global trades now being executed not by people, but by AI algorithms. Now, this isn't just some small shift, right? This is a fundamental, ground-up transformation of how the market actually works, and you have to wonder, when 89% of the players are all thinking in similar ways, well, that introduces a whole new kind of systemic risk.
And that risk actually has a name: the doom loop. So here's how it works. When all these algorithms, which are trained on pretty similar data, all get the same negative signal, they can all start selling at the exact same time. This creates this nasty feedback loop where selling just triggers more selling. And then liquidity, which is just the ability to find a buyer for what you're trying to sell, it just vanishes instantly. And that's how markets can flash crash. So how does this analysis make sense of a market where almost 9 out of every 10 decisions are automated? Well, it actually pulls from some classic market theories to explain why this time might not be so different after all.
You know that famous warning from Ken Fisher? It applies perfectly here. This belief that AI has ushered in a new era of permanent, non-stop growth, well, that's exactly the kind of thinking that, historically, tends to show up right at the peak of a market bubble.
And this quote just nails the core of the problem. You've heard of the wisdom of the crowd, right? It only works when the crowd is made up of diverse, independent thinkers. But, as complexity scientist John Casti warns, when everybody starts copying each other, that wisdom turns into the madness of the mob. And with 89% of trades being run by AIs using similar data models, they're not a wise crowd. They are a synchronized digital mob.
Okay, so with that risk clearly laid out, let's look at the specific forecast for the AI sector itself. This analysis predicts that 2026 is going to be a year of two completely different halves, a real tale of two markets. So the forecast is for the AI market to be sitting on what the report calls a fragile plateau. The first half of the year, that's going to be driven by what it calls optimism's inertia. But then the second half is going to see this dramatic shift as the fear of reality, lack of profits, regulatory crackdowns, finally starts to set in.
So all the way through June, the party is expected to keep going. We're going to see exciting new product launches, things like Baidu's OpenClaw. Over here in the US, consumer spending is likely to get a nice boost from increased tax refunds. And of course, corporations are just going to keep pouring money into their AI infrastructure. Even some positive regulatory steps, like the proposed Clarity Act, will probably help keep confidence high.
But then, in the second half of the year, the whole story changes. The analysis says the triggers for a downturn are just going to multiply. We're talking about increased regulatory heat, like the FTC's investigation into Microsoft, and just growing doubts about whether these AI companies can actually turn all this hype into real profits. And as the broader market cycles start to turn negative, the analysis predicts the chance of a major doom loop event actually rises above 70%.
Now, this AI risk isn't just happening in a vacuum. A doom loop event could absolutely trigger a global chain reaction. So let's take a look at how this report forecasts these pressures will start to crack major financial markets all around the world.
So, for the US, the forecast sees the S&P 500 going through a pretty significant 15 to 20% correction, pulling it back to the 5,800 to 6,000 range. A huge risk factor here and a potential trigger for those algorithms is the commercial real estate sector, with an estimated $120 billion in defaults expected. A potential bright spot, though, the defense and aerospace sectors, which are being fueled by ongoing geopolitical tensions.
Popping across the Atlantic, it's a similar kind of story. The analysis suggests Germany is actually shifting to a war economy footing to meet new defense demands. Now that's boosting its industrial sector, but it's putting a huge strain on public finances all across the EU. The UK, meanwhile, is expected to see pretty limited growth as it keeps navigating its post-Brexit world.
Over in China, the forecast is for a continued L-shaped recession, mostly because of weak demand at home. But for Hong Kong, the situation looks even trickier, as its companies become direct targets in the US-China conflict. A really key signal here, the report notes, is the recent sale of the Waldorf Astoria Hotel, which it interprets as a sign of some pretty desperate capital flight and deleveraging.
The analysis uses this really vivid metaphor for South Korea, the nutcracker effect. So picture this. On one side, you have the new US-Taiwan trade deal, and that squeezes Korea's export competitiveness. Then, on the other side, you've got rapidly advancing Chinese manufacturing just eating into Korea's market share. The forecast says the Kospi is going to be caught right in the middle of that squeeze.
All right, so given this really complex global picture, how does the analysis suggest we should navigate this so-called sandcastle market? Let's move into the final section and see how this all plays out in the currency markets and what the big takeaways are. This table breaks down the currency forecasts pretty neatly. The Korean won and the Chinese yuan are both expected to weaken against the dollar, driven by those export pressures we talked about and their own domestic policies. The euro is also forecast to weaken because of poor fundamentals. The one real outlier here is the Japanese yen. The analysis predicts a potential shift towards strength if, and it's a big if, the Bank of Japan finally decides to raise interest rates.
So if you take away just one thing, it should be this. We are operating in a fundamentally new kind of market. That classic idea of a market discovering the right prices through the diverse actions of millions of individuals, that wisdom of the crowds, it's been replaced. Now what we have is the synchronization of algorithms.
So what should you take away from all this? Well, first, that whole "this time is different" fantasy is probably coming to an end. Second, the biggest threat out there right now is the systemic risk from these synchronized algorithms. And finally, the analysis suggests it might be worth considering sound assets like gold and Bitcoin as a potential hedge against all this instability and the threat of those doom loops.
And that leaves us with one final, pretty provocative thought to chew on. If 89% of the market is just machines executing code, what is the role for human experience, for gut feelings, for intuition? In a market that's been built by algorithms, where does the human mind really stand?